I mean, you could probably guess this one, right? Chart of the day today has to be the dot plot that the Fed released when it put out its latest summary of economic projections at 2 o'clock. So many viewers of this show will be familiar with the dot plot. What is the dot plot? Some of you may be asking. The dot plot is where the Fed thinks interest rates will be at the end of the years outlined on this chart. So at the end of this year, the majority of Fed officials believe interest rates will be at the levels that they are at today. That means there will be no more rate hikes, according to the median dot that the Fed released today for the balance of this year. 2020's chart shows that the median dot calls for 1 rate hike next year, although the plurality of dots suggests there will also be no rate hikes in 2020. So the Fed is now on hold for at least the next 7 quarters, according to that chart. You go to 2021, we're getting a little wishy-washy. Over the longer run, also notable on that chart, we're starting to see the longer run projection of what the neutral rate of interest for the economy would be. This is the rate where you have 2% inflation, full employment, the economy's not too hot, not too cold. That's coming down. So for a long time, all the way on the right hand of this chart, we saw long-run dots at 4.25%, right? The textbook tells you that inflation plus the 10-year is where you get that long-run interest rate, and that was over 4% for a long time. Well, experience has taught us that that is certainly not going to be the case. That's not really the setup that we're looking at right now. And so we continue to see the longer-run estimate for where the economy needs to be come down, and we see that come down with the unemployment rate. We saw growth revised down, and so it's just a big rethink today from the Fed.
Yeah, we haven't talked about the dot plot in kind of a while. Why is it so important this time around, Myles?
I mean, it gives away the whole story, right? Like the dot plot usually is an evolution. It's not something that changes as dramatic. It's never changed as dramatically in one meeting, in one quarter, as it did this time around. So you say the dot plot is, oh, it's a tool the Fed likes to use. But as it's continued to be released, more and more people focus more and more intently on the dot plot. And now it's the most important thing the Fed puts out every quarter.
Well, and what's also interesting is that Jerome Powell not too long ago kind of warned about the dot plot. It was just saying don't place too much emphasis on it because the median is not always the right indicator. But it is interesting, definitely what you're saying, the change that we have seen in the dot plot is obviously very significant here as we look forward.
And yeah, exactly. Like, Powell can say a lot of things. Any Fed official can say whatever they want about how they're thinking about policy. But ultimately, and I'll give Powell a lot of credit on this, ultimately it is up to the Fed to understand what the market is reacting to in terms of their toolkit, how they're speaking, the information they put out. And they are very aware that right now the dot plot is something the market is very sensitive to. And so I think that is what led to such a sharp revision today, is the Fed knew if they took the dot plot all the way down, no hikes this year, no hikes next year, the market would react in kind, and that's what we're seeing today. Of course, if you're a regional bank, that's not very good, and we're seeing the reaction in markets today. If you want to be long Facebook, yeah, sure, why not? Stock's up 2.5%.